In the last video, we saw that Mike wanted to buy shares of Johnny's Lemonade Stand. In this section, we're going to talk about how he's actually going to make that happen. To buy the shares, Mike is going to go out on the stock market. And the stock market is just like any other marketplace. So for example, you go out to buy groceries at the grocery store or farmer's market, something like that. A market is simply a place where buyers and sellers get together. So the stock market is simply a place where stocks are bought and sold. Two of the most common places are the NASDAQ exchange and the New York Stock Exchange. These are places where stocks are listed for sale, and brokers, so TD Ameritrade or Fidelity or Vanguard, can go out to these exchanges and buy or sell stocks on behalf of their clients. So in this case, let's say Mike has an account with Fidelity. So Mike's going to go to his Fidelity login and say he wants to buy 10 shares of LEMN at $1,250 per share. Now, the exchange is going to get this trade request and try to match it with another party who wants to sell their shares. So let's say at the same time Mike places his order for 10 shares, that Ben places his sell order for 10 shares at the exact same price. So then the NASDAQ exchange, where LEMN is listed, is going to see both of those orders and match them together. So Mike is going to transfer $12,000 from his account going to Ben, and Ben's 10 shares of Johnny's Lemonade are going to go into Mike's investment account. That is the basics of how the stock market works. You have a bunch of different people who are wanting to buy stocks of certain quantities of stocks at certain prices, and you have a list of people that are wanting to sell their stocks, different quantities and different prices. The exchange just matches those buyers with sellers, and they exchange shares for dollars.